Welcome back. As we navigate through a period of significant economic dynamism, one trend capturing the attention of savvy investors and financiers alike is the burgeoning boom in private capital expenditure. This is a transformative shift in how we innovate. But herein lies a pivotal question. Does this boom present a golden opportunity for private credit funds to smartly deploy capital and achieve high double-digit returns? Our next set of panel will shed light on the opportunities that the current capital expenditure boom presents. On that note, ladies and gentlemen, let me welcome the panelists. Mr. Akash Desai. Mr. Akash is the head of private credit at 360 ONE Asset. He has a rich experience of about 2 decades of diverse experience in institutional financial services and specializes in the areas of corporate and structured finance, syndication, and capital markets and treasury. Prior to 360 ONE Asset, he was associated with Clicks Capital in the capacity of head corporate and structured finance business. Mr. Shekhar Daga. Mr. Shekhar joined ICICI Prudential Asset Management Company Limited as head private capital in March 2021. He has over 2 decades of experience. Prior to joining the AMC, he was partner at Ion Capital, a private equity fund where he was responsible for originating, executing, and managing buyout transaction, structured credit, and distress deals. Mr. Nikhil Garg. Mr. Nikhil Garg is a seasoned professional in the realm of structured credit, boasting an impressive tenure of over 14 years in the industry. Nikhil has garnered extensive experience across various facets of debt capital markets, including DCM, private credit, structured finance, and credit risk. His career has seen him make significant strides at IDFC First Bank, RBL Bank, and a subsidiary of Bank of America. In his latest role at IDFC First Bank, Nikhil led the origination efforts of the DCM desk and was instrumental in orchestrating a diverse array of structured credit transactions for AIFs, FPIs, and the NBFC market, underlining his expertise and leadership in the financial sector. The session will be moderated by Ms. Lakshmi Iyer. Ms. Lakshmi is the CEO of Investment Advisory Business at Kotak Alternate Asset Managers Limited. She has been with the Kotak Group for over 22 years. Prior to joining Kotak, Lakshmi worked with Credence Analytics Private Limited as a research analyst where she was tracking corporate bond markets in India and generating research reports. She holds an MBA degree in finance from Narsi Monji Institute of Management Studies. She has been recognized as one of the top 25 most influential women in asset management in Asia by Asian Investor. Over to you, Ms. Iyer.
Thank you so much. Hi, and a very good afternoon to each one of you. Sorry, I'm a little bit under the weather and I'm happy it is a virtual event so that nobody is, and I don't have COVID, by the way, I've already tested for that. So that's not a worry, but I think there's just too much of dust allergy or pollen allergy happening across and too much of travel. But I know that's not the agenda for discussion today. Before we move into the Indian credit market and deep dive, just quick, couple of I would say hard-hitting data points. And we all know that the credit hawa, as we call it, or the flavor is not just India, it's actually top-down. So the size of the credit market just, under 4 years back, which was less than $1 trillion, is raging towards almost $2 trillion from a global standpoint. This number is likely to double in the next, 3 to 4 years. And in typical movie parlance, I don't know how many of our viewers have seen this movie called Donkey. So donkey market, they are, we saw, in the movie where Shah Rukh Khan was the male protagonist, we actually saw a lot of, people wanting to go a border ke us par to London, donkey market. So, Sam, Dam, Dand, they wanted to go. So I think the similar narrative is happening that globally investors want to own, high yield assets. Closer home to India, there's this very recent EY report, which I'm sure all of us would have read. The investors' love affair, with credits is more like Rocky or Rani ki prem kahani. And the numbers are actually, showing you. We've seen almost 108 odd deals this year. I'm talking about the CY 2023, totaling to about $8 billion. And this number was just about $5 billion last year. So, again, before I kickstart the question, this actually reminds me of the movie Animal, where Abrar actually does this entry, and there is this very famous song which says Jamal Jamale Jamale Jamal Kudu, which basically is saying, "Oh my love, my beloved." So that is what the investor is actually singing to the high yield in India today. So the question to you, Shekhar, I want to kickstart with you. How real is this boom that we are seeing globally and specifically in India? Are we talking of Singham again, assuming the Singham was born in 2023 or maybe even later in movies? 2024 will see the release of Singham again. So are we in that kind of a moment with respect to private credit in India? Shekhar, you're on mute if you're speaking.
Yeah. Thanks, Lakshmi, for laying out the entire agenda very in a filmy way, actually. And I may not have seen few of the movies, so may I have not related to it, but it's very interesting. So definitely, whether it's a Singham or not, I think if we split into two parts as asset management, raising money and deploying money, actually the two parts to it. The way I see it, like the boom for private credit, I think it's going and the numbers are stating for themselves. I personally believe the next 12 months or 18 months will be far more exciting in terms of the deals, where effectively the Indian promoters, corporates, would be looking for this kind of capital, which effectively is becoming a big space for people like us. Now, the only bigger challenge which we see is the supply of capital, because definitely as private credit is a buzzword, but you need to see private credit can be from a 12% to a 25% yield, and different pockets have different demand supply dynamics out there. And the capital which we speak as we speak right now, which is available in private credit, I believe we may be short of capital in some part, like the domestic fundraise or the domestic investors would be limited. We will need more institutional money to come in. But from a supply side of investing money, I think we would be, I think is a good time for people like us to say a lot more no to a lot of deals, because you can pick and choose what deals you would like to do. But definitely there would be a time when we will have a lot of money and that pressure will come. But fortunately, as we speak, there is more demand than supply of in terms of capital. So I personally see like next 12 months, we may hit a $10 billion number, definitely next 12 months for sure. And I think more funds will come in the industry. It's not that, and there would be some competition, which is always welcome. So the industry will grow to the next level and become more mature as we move for the next 12, 24 months, actually.
No, absolutely. I think 8 billion growing to maybe $10 billion in the least and more. And Shekhar, I promise you, if I quote any movie, I will also give you the English translation of the context of it, so that, one is not lost. The Bollywood, Hollywood tussle. But Akash, Shekhar mentioned $10 billion. We are already at $8 billion. How big do you see the size of this opportunity, number one? And specifically in Indian context, we were a once deemed gully boy. How have we fared versus our global counterparts?
So, I mean, look, there are various reports out there as to how big the market can be. In our view, there's going to be a 200-300% increase at least. So if you say the market today is about 15 billion, over the next 4 to 5 years and half a decade is probably a good cycle to look at any market trend, right? We think there will be between a 50 and a $60 billion market over the next 5 years. And like Shekhar said, the market will evolve into sub-segments of private credit. It's obviously a umbrella term for a larger market that essentially is for providing fixed income capital outside of the conventional pools, right? So if you take out banks, NBFCs, and mutual funds, everything else essentially falls into some form and shape of private credit, right? Right from real high quality NBFC performing credit at one end and then doing real distress and venture debt at the other. That market, in our view, could be anywhere between 50 and 60 billion over the next 5 years. Obviously, sub-segments will grow at at a different pace, but we think structurally, all of these sub-segments will grow at an immense pace going forward.
So, we are talking about size, we're talking about scale, we're talking about the kind of opportunities that lie ahead of us. Nikhil, probably digging deep down into this, any specific sectors, or industries, if not sectors, are likely to be taking a head start, within this space. Basically, who is the Adi Purush in this entire game within sectors?
So I think typically capital intensive sectors, are to start with, and it's the head start is given by the government through their public capex program, and slowly that would flow into private capex also. So I think many of the government initiatives to start with, right from the PLI schemes, the 13-14 sectors that are covered under PLI, defense, railways, the usual renewables on the EV space, smart metering space. I think areas where the government is putting a thrust with respect to capex is something that to start with would be areas where private credit would be really required. Starting right from the PLI schemes, the 13 to 14 sectors that the government has sort of shortlisted from an investment perspective. Apart from that, on platforms which are being created in renewables, on the EV side, on the smart metering side, these are typical sectors which are very, very capital intensive, and a large amount of the capital needs to be spent upfront. And I think those are typically areas where private credit would play a very important role, because it takes some time for a long source of capital to come into these kind of projects. So private credit typically would provide the interim capital need that these sectors require. And well, I don't have specific numbers per se sector wise, but I think these are the broad areas where such kind of flexible customized capital would really work in sort of giving an impetus to these sectors.
And I think to Nikhil's point, I think these are the segments which are looking for long-term durable money, which I think private credit funds within the AIF umbrella are clearly able to fulfill. Akash, while Nikhil alluded to the sectors which are the likely Adi Purush, any sectors which are a complete no-no for you, chuna mana hai, they come to you and like the movie Stree, you say, oh Stree kal aana. Any of those kind of sectors that you'd like to highlight?
So I think for us, we've within the niches that I spoke about, I think we've zeroed in on looking at a sector agnostic performing credit strategy, and we've looked at saying, and you'll kind of learn from your past, and all of us have been in the industry for far too long and seen far too many accidents. So I think for us specifically, we've gone out and said we will not do real estate or any industry that needs approvals to generate cash flows. We will not look at asset light industries, and we'll not look at industries which have a very thin margin and hence a very low margin of safety, right? So if you apply these three principles, I think one would look at probably staying away from real estate within our credit umbrella, away from looking at project finance, which is essentially long-term needs of capital, and more asset light services based industries where probability of default could be low, but loss given default could be high, right? And that's the real focus for us. Just to explain, we've now made 47 investments over the past 3.5 years, zero defaults. We've evaluated 314 transactions. So our approval rates are low, but I think the fund's performance is, touchwood, very robust, primarily because we've stuck to, we think, what we know best, and which is a sector agnostic, old economy, industrials, energy, pharmaceuticals, chemicals, that kind of space where one can look at assets, one can look at cash flow, one can diligence sort of volatility in the industry, one can look at cycles. So I think for us, these are are some sense of a no-no and some sense of a can do. But in general, what I think, if I could answer the question differently, people
No,
find niche.
yeah.
So
Sorry, I think I lost you. Kash, are you trying to speak?
Lakshmi, you say something.
No, I think I got you on your sector part. I think that kind of articulates it pretty well. And also from an audience perspective, if you want to eat samosa, try to eat air fried samosa. I think that's going to be the way you need to slice and dice from a sector perspective and a do's and don'ts. Moving on from selection and the opportunity size of the opportunity, Shikhar, I'll move on to the investor side. Once perceived Cinderella is now the charming princess, and she finally gets the prince without having to worry about her chariot turning into a pumpkin. What is the kind of investor interest? Are you seeing that sustaining in these opportunities? Are you likely to see it enhance, or is there any safeguard that investors are building in right now?
So Lakshmi, she is very specific at the time period when you are raising capital in India actually. So as we speak, like equity is the flavor, and a lot of like the normal families or the HNIs are more skewed. So what we are seeing is that like people who do an asset allocation strategy and who have a carve out of like the various investment pockets they would like to invest, they continue to have a investment strategy in private credit. And again, in private credit, as we started earlier, it can be a performing credit, or it can be a real estate, or it can be an yield fund, or it can be a venture debt or a special situation fund. Definitely, people do get driven by the returns, which is the first thing actually, and very effectively most of the capital will go to a special sit fund or a high yield fund. Because the returns kind of attract as a human tendency, you always want to chase higher returns and you are willing to play that higher risk. But having said that, I think performing credit, the base which we think of between a 12 to 16% kind of a return, I think people are seeing that as an alternative. Because the traditional products are not yielding that kind of return on a post-tax basis, because as we speak, the taxation laws, since they have changed, I think AIF investments do carry a kind of a slightly higher risk, but based on a calculated risk, the return expected are far higher. So we believe like the investors will start, and rather they have been allocating capital. But this is a asset class where we all need to work towards more investor awareness, like what kind of sizing allocation one needs to do, and also reach out to more bigger set of investor profiles, being insurance or the traditional institutional players who like to do it. But I think people's interests are there as we speak right now. Different a kind of a risk averse investor will like to go for a mutual fund, or maybe slightly move to a performing credit fund, and somebody who is liking an equity kind of a flavor or equity upside we like to go for a more distressed turnaround strategy actually. So different flavors are there. Investors, as we discuss with them, we ask them based on their risk appetite. It is for them to choose what kind of risk they are comfortable with, because something which I say is that in credit there is no stop loss. In public equities, if you do, even if you happens an accident, you still can exit at a loss. Unfortunately, in this business, you need to do all the diligence and the work much before. Definitely there can be a secondary market, but India, we have not evolved to that stage. So the investor should be very particular what risk he's willing to underwrite, because credit, one accident kind of wipe out the returns of a fund actually, or it will tell you the return substantially. So investors are very cognizant. So larger family offices or people with large capital pool will play across strategies. Certain institution will play on the more performing credit space and maybe some parts in venture debt. But I think my belief is that people should be graduated step by step. So people who are entering first time from MF credit risk should go to performing and then have a taste of it and then move to the next level actually. And I believe that's the way most of the advisors have been telling their clients. And I think as we see, the industry will get into much more evolved and develop phase in next few years to come. But investor interest continues to be strong. Definitely, equity market ups and downs will also kind of direct us in what kind of pool of money we can raise on this.
No, very true. And in again in food parlance, there is film and food that I think all of us can relate to. If equities is meat, then at least credit should be mock meat. In terms of risk profiling, it might be, or in terms of visibility, it might look very similar. But of course, the return expectations may not be as high ended, given that it's a very different nature of the beast. But Nikhil, I'll bring you here in because Shekhar did allude to the fact that investors need to categorize if they want to move in, depending on what kind of risk appetite they have from depending on private credit AIFs, or they want to do mutual fund credit. My question to you is, mutual funds are now entering the private credit space. They already have mutual fund schemes, but they're also looking to launch AIFs, on the high yield side, specifically private credit. Now, I don't know, have you seen this movie Fighter? There is this constant aerial war happening between, say, Hrithik Roshan and, Bash, who's one of the slays it. And then there is this villain who's red nose, and there is this constant aerial war happening. So is that going to lead, and in our industry, in this fighter industry, is that going to lead to undercutting of pricing, which is so very important to maintain the high yield nature? Or you think hum sab saath saath hai and sab mil baat ke khayenge? Any views on that?
So, I mean, a very valid question. And we also, within teams sort of have discussion on this specific piece. See, as of now, the private credit market is growing quite significantly. So there is enough and more in the market with respect from an investment perspective. And as Shekhar rightly said, it's more about supply of capital that needs to be abundant. So I mean, as of now, I don't see that sort of colluding happening. But of course, few years down the line, where most of the AMCs come up with their AIFs, there is enough supply. So maybe at that point in time, things like that could happen. And specifically from an AMC perspective, and I can speak for on the behalf of Axis. So typically, most of these have transitioned from a credit fund to an AIF, to a credit AIF. So sort of the underwriting thesis from an AMC perspective is very similar. It is we all understand traditional businesses. It's more of a regulatory arbitrage that we are working on, because at least for us, most of our investments are in areas where typically a bank or NBFC from a regulatory perspective is not able to lend. But the credit underwriting thesis sort of remains the same, and that's why it's performing credit and in the range of 13 to say 15%. So it is relatively much safer credit. And in areas where traditional banking or NBFCs are not supposed to lend, that's basically the philosophy basis which a lot of the AMCs are coming up with their funds. So I think this specific piece is there to survive, there to exist for a very long time, and there is enough and more opportunities going forward that will come in this area. So I personally don't feel that such kind of price cutting will happen. But yes, of course, we are competing with NBFCs as well at some point in time. So I mean, it's still a long way away to come to that conclusion. But yes, there could be a possibility at some time in the future.
Okay, Nikhil, since you mentioned opportunities, I want to stick with. Sorry, Akash, you were saying something?
Sorry, I was just adding to what Nikhil was saying. If you let me,
Yeah, please.
I think from the way I would sort of look at that narrative is to say that, look, some amount of mispricing is bound to happen when any opportunity presents a stellar sort of promise, and you'll find a whole host of people entering a space, right? But over time, I think what will end up, what should or could end up happening is, the supply of transactions is going to navigate towards people who can either have scale, because scale, in some sense, if I can use a very colloquial word, might is right? And the larger you are, the more scale you attract, and it becomes a sort of a vicious positive cycle, right? The second is your ability to provide solutions. I mean, yes, today a lot of transactions are acquisitions or PE exits or growth capital, but there will come a time where this pool of capital could coexist with each other, but also coexist with banks, right? Today, we do a lot of transactions where, for example, Shekhar and I compete, but we also collaborate, right? So we do lots of co-invest together, but we also compete on trades. And in each of those trades, there is always a bankable portion, right? But if your ability to give a flexible capital solution exists and you can solve for scale, I think that itself will drive more and more opportunity and then become a positive growth cycle, if you will, right? So I
Yeah,
just want
and more like a virtuous cycle also of some
that's right.
sorts.
That's
That's
right.
true.
Sorry, you were asking me, Rasmin.
No problem. So, Nikhil, I think that's a very valid point Akash you made. But Nikhil, since you were on opportunity, my related question to you is, while India looks attractive, it's really beautiful. But, if there is another bride that you would like to wed outside of India as a region, and that bride in the private credit space would be which region? I mean, which other country looks attractive to you from a high yield perspective?
So I think it's typically the Asian markets that look attractive, the likes of Thailand, in Indonesia. So I mean those are typically economies which have done well post pandemic, and from a fiscal perspective also are doing well, and have a lot of domestic consumption intact. So I think those are typically areas where the demographics are similar to what India is, where high yield market or the private credit market could be attractive.
So if you were to pick up, say, between China and Japan, would you choose one, or you'll say no?
I would
मुझे
choose
तीसरी उंगली दिखा दो.
तीसरी उंगली दिखा दो.
All right. Shekhar, I want to bring you in here, and it's a so small little role play question, but please be sporting enough and answer it. Have you seen the movie Nayak, where Anil Kapoor was made
Yeah.
CM or PM? I don't remember. Akash,
Yeah.
we need to see more of movies. Okay, Shekhar, you've seen it, so perfect.
Yeah.
So if you are made the regulator for the AIF industry for a day, what would be the top 3 changes that you would like to suggest?
I think we are beautifully regulated. Like there is no more incremental regulation or dilution which we need to have. I don't see our regulator had done a great job per se. So I frankly have no like specifics. Yeah, there are minor tweaks which are here there, but they are nothing worth mentioning or like it. I think we will solve it over a period of time. But I think in terms of the structure, the way we started with a very great footing in terms of how the AIF should work, what kind of investment process and everything. I think the regulator regime has been pretty strong. So rather, I will not take that headache of making any dramatic changes because we are a young industry and I think there would be some teething issues and they will get solved as we move forward and then we encounter more problems. For now, I personally don't see there is any dramatic change required per se. Taxation was a big thing, which I think has been resolved actually substantially, or rather it has been resolved. Yeah, and I think that's nothing much beyond. I think Lakshmi, I will let to comment on that side.
Lakshmi,
No,
can I
fair
just
enough. No, Akash, I'm going to come to that question to you also. But yeah,
I try and become co-chief minister, for example, and try and sort of take a
no,
stand.
no, wait. I'm going to ask you the question. Wait, but I'm saying that let Shekhar remain the regulator for the day, and you have to give him a wish list on that day. What will your wish list for the industry be?
I have 3 at the top of my head. One, allow insurance and pension capital to enter the industry. It's the longest, most sustainable form of capital. The asset segment of private credit is very well suited to that space as a diversification tool because yields are locked in. So it's stable returns for long-term pensioners and so on and so forth. Second, treat equity and debt tax the same. Today the taxation prefers equity investment, so harmonize the tax. And 3, let there be more conduct-based regulation rather than saying I'll allow this and I'll disallow this. Right? The recent regulations in terms of RBI not allowing banks to invest and so on and so forth. I would say let them be conduct-based regulation and practice-based regulation where each of the asset managers takes it upon themselves to say I will indeed follow a code of conduct, but I will follow the spirit of the law, but also the letter of the law, rather than making it very sort of micro instruction based, right? So those are the 3 asks I would have from all our regulators.
Brilliant. I think you nailed it. I think some of these aspects, are something we also at Kotak are deep diving into. It's important that this is an industry which is raring to go. It is, in true sense, allowing for the capex boom to flourish, and therefore it's very very important that there is a born hobby kind of an ecosystem that prevails, not the fighter attitude, but the liver attitude, not the Ori wala liver, but the liver, like actual liver attitude, which is very, very important. And as we are, ending this absolutely illustrious panel, I can't give away the podium to the host without, recalling. Have you all seen the movie Sam Bahadur? Any of you all?
Yes, we have Lakshmi.
Excellent. Akash, at least I'm glad at least some movie you've seen. Fantastic. So, in Sam Bahadur, there's this very interesting dialogue which says that army ka discipline uski neev hai. So, army's discipline is its foundation. So, likewise, if that analogy I extrapolate, credit fund, private credit fund ka discipline, uska structuring or underwriting standards hai. I think so. It's very important for us to be the pole bearers and the torch bearers of that. To ensure that this fledgling industry continues. And on a parting note, as Sam Bahadur said, a field marshal is always on duty. Therefore, surveillance through the life of the asset of the fund and of course the tenure of the fund is an absolute non-negotiable. Thank you so much for being a wonderful panel, and thanks to the audience. Over to you.